Hello, Vision Nation. You've seen the scary headlines about a looming recession, but what's actually the current state of the US economy? In this episode, I'll speak with Sam Burns. He's a senior equity strategist with over 20 years of experience in financial markets. We're going to cover Sam's take on the economy and his outlook to later this year in 2024. We'll also go over something that confuses investors all over the place. I've personally heard experienced investors puzzled by this. What I'm talking about is why we sometimes see scary headlines about the economy while the stock market keeps hitting new highs. Sam and I will go over this phenomenon. We'll discuss whether inflation is finally under control or if there are nasty surprises on the horizon. And we'll also get into the best hunting grounds for solid investment opportunities today. I really enjoyed speaking to Sam. He's a true expert and has a ton of knowledge about the economy and the markets. You don't want to miss this one. Let's dive right in. Hello, Vision Nation. Sam Burns is a senior equity strategist with over 20 years of experience in financial markets. He is the founder and chief strategist at Mill Street Research. Mill Street Research is an independent investment research firm devoted to providing high-quality strategy and stock selection research to institutional investors. Sam, welcome to the show.
Thank you for having me. My pleasure.
And Sam, I wanted to start things off by mentioning that our listeners have told me that they really enjoy understanding the context that different guests bring to the show. And so I wanted to ask you, can you tell us a little bit about yourself? What kind of work are you doing these days? And what led you to starting your own independent research firm?
Oh, sure. Yeah. So I've been doing this kind of work, which is primarily asset allocation and stock selection research for institutional investors for a long time. My first real go at it was working at a place called Ned Davis Research down in Florida for a while, and then I moved up here to the Boston area and have worked at places like State Street Global Markets, Brown Brothers Harriman, and Oppenheimer and Company. So I've worked at sort of smaller firms and bigger firms doing research of different types, but always with a quantitative bent, building models and indicators, kind of having an objective quantitative approach to markets and the economy has really been the common thread behind it all. And that's really kind of my personality of, I need a structured approach to how to deal with markets because there's so much that can be, kind of get you off track with looking at the headlines and watching prices every day. It's very easy for your emotions to get away from you or to get distracted by things that aren't really relevant. And so having some kind of a structured approach has been what I've been thinking my job to do is, and to help institutional clients who actually, even though they're professionals, face a lot of the same pressures and are very busy and don't have time for a lot of things, to give them information they can use to make investment decisions and to understand why and where it's coming from. That it's not just I made it up today. It's there's a process and some data. Do a lot of historical testing to kind of back up what I'm saying. It's really been a kind of a trend of that and building all these kind of tools. And then I went independent about 7 years ago as a way to bring all the best of the best tools that I've made into one place and be able to have full control over them and have no conflicts or kind of things where I don't have to worry about what investment banking side of the business says or a trader says, or I only do research and nothing else. So all of my views are my own. I can say buy or sell anything I want and don't have to worry about what anybody else says about it. So that's really been the focus of what I've been trying to do.
Yeah.
So that's what Mill Street is built around.
That's really powerful to be able to provide kind of a totally unbiased, well, in terms of internal, everybody has their own biases, but internally, nobody is kind of telling you, oh, you got to go with this sort of theme. So for an external investor, just to be able to tap in and see, oh, what does Sam think about this? That's a really powerful thing because internally, there's all these politics going on and things like that that can really cause the decision making process to be inefficient.
Oh, absolutely. Yeah. No, I've seen it a bunch of times at different firms where whatever the analyst might privately think, they're told by someone, well, no, we can't say that. We don't want to pitch that way. A company would get mad, or the holders of the stock would get mad, or somebody would not like that. or we're in the business of selling stocks. We can't, we want people to buy. We don't want them to sell because that's bad for business. All those things are sort of the underlying incentives to a lot of the business that's based on transactions and things like that, investment banking. And so it can be a bad influence on giving, really objective advice. And so that's why I think, being independent is a big benefit there.
Oh, it's huge. It's huge. And so shifting gears a little bit, I find that many investors that have various levels of experience can still get a little bit confused by this. Why is the market not the same as the economy? Sometimes you see crazy headlines saying that, job losses, conflict somewhere in the world, et cetera, et cetera. And at the same time, you might see the market actually doing well. So why is that?
Yeah, no, it's a very common thing, and even again, professionals sometimes get thrown off by looking at what they think is the economy is, and then being surprised by the stock market doing something different. And there's various aspects of that. One is that um, some of what you see in terms of the economy means data like the GDP, gross domestic product data, some of those big picture economic reports that you see. Those often will tell you what has happened, last quarter or last year. And the markets are really focused on what's going to happen over the next year, or next 5 years, next 10 years. And those two things, can be different. If things have been weak lately, but you think they're going to get better, then stock prices will reflect what's going to happen, or people think is going to happen, not what's already happened. You don't get paid for what happened last year. You get paid for what's going to happen next year. The other thing is that certain things like a layoff announcement, what investors are in equity certainly are focused on is corporate profits. And so if cost cutting means profits go up, then there could be a logical reason why a restructuring or something like that could cause a stock's price to rise, even though they're cutting jobs. It depends on whether it's caused by demand being weaker, or by simply they had their cost too high and now they need to adjust. And the other thing is that the economy encompasses individuals, households, and businesses, and the government. And the stock market really is only businesses, and it's only publicly traded businesses. And really, mostly people are looking at large publicly traded businesses that are in the stock market indices. And so that's really only a sort of a subcomponent of the overall economy and the corporate earnings that go with it. So there's a lot of other things going on in the economy that are not going to directly drive stock prices and corporate earnings, that are still important, but are not going to be what you refer to where you're going to be important for predicting future stock prices. I think that's a lot of what people kind of get confused by, is what they're measuring and looking forward rather than backwards in some ways.
And those are great, great points. And would you say the market, what kind of time frame that, I mean, this is very broad, of course, but just your interpretation, does the market more focused on, the kind of 2 year time frame, 2 to 5 years, five plus, and does that change?
It certainly can change, and it's funny. It's one of those things where if you read the financial textbooks, if you do your CFA or your MBA or whatever they teach you, equities in particular are long duration holdings, meaning that when you buy an equity, you're participating in all the future profits that the company will ever make, which could be many years. So in theory, you should be focused on the long term outlook. So maybe 10 years, 20 years even, because stocks don't have an expiration date, and so they do come and go, but they don't have a duration like bonds do. But in practice, when you actually look at how investors behave and the way the markets behave and the way investors actually make their decisions, they mostly tend to look at, say, 12 to 24 months ahead. That's really about as far as anyone can have a prediction about earnings or interest rates or the economy with any kind of real hope of any precision. Otherwise, you're just kind of saying, well, it'll be a X% growth rate, and that's just kind of a general guess. And so most people are thinking about a year or two out typically, even though in theory, according to the textbook, you should be thinking about 5 or 10 or 20 years. So what you think of is going to happen over the next year or so tends to be what drives stock prices in practice.
That makes a lot of sense. And so looking at today's US market landscape, what are you to keep track of many indicators in your models? What are your indicators telling you right now? What is Sam's crystal ball telling him?
Yeah, I really wish I had a crystal ball. That would make things a lot easier. But yeah, the indicators I look at have been bullish on equities and bearish on bonds for all year, and really starting late last year. That really, around October, November, December of last year, it basically looked like everyone was extremely negative and bearish on the economy and the market on corporate earnings, and really thought that that we're going to have a recession this year. Like right now, we should be in recession if they had been right, and that there was just a high degree of negativity about what was going to happen. A lot of it was because the Fed was going to be raising rates aggressively, and because all the stimulus from COVID was going to go away, and then therefore we were going to kind of fall off a cliff and go into recession. That hasn't happened. And so the fact that things were not as bad as people expected them to be has meant that the stock market's up and our corporate earnings are up, and that's turned out better than expected. Not that things are spectacular, but they are pretty good given what might have happened. So I think that's kind of been the driver of what's been happening and why stocks have been holding up, even though bond yields have gone up a lot and the Fed has raised rates aggressively, which typically historically would be a bad sign and may wind up being a bad sign. I think what's happened is that fiscal policy, the other side of kind of the policy equation, has been very, very supportive. Because first you had all the COVID stimulus, everybody got checks or PPP loans and all those different things. And then that kind of faded away a year or two ago. And now, but more recently, you've gotten all these infrastructure related bills that got passed: the Infrastructure Act, the CHIPS Act, the Inflation Reduction Act, have all driven a lot of like kind of longer term infrastructure manufacturing kind of growth. And you've seen that in the economic data. A lot of factories being built, a lot of things going on. And that's been showing up in corporate earnings and in the data that I look at. So it's been that fiscal policy has almost offset monetary policy. And everybody looks at the Fed and monetary policy because that gets all the attention. And they've kind of overlooked fiscal policy, which has been very different this cycle than on all the past cycles for the last 40 years. So I think that's been the real difference this time. And I think that there are some that can continue for a while longer. The fiscal policy support should help for the next at least 6 to 12 months. And then it's a question of, well, are interest rates going to offset that? Is the Fed going to kind of go too far? Or is the rest of the world, going to slow things down so much that brings kind of the U.S. down as well? So the U.S. has held up a lot better than Europe or China or most other parts of the world. And again, a lot of that is driven by U.S. Fiscal policy. So I think that's been the big swing factor and why stocks have done much better than people expected.
That's such an important distinction, the fiscal policy side of things versus the monetary policy. What would you say? So you mentioned that in the past 40 years, the fiscal stimulus hasn't really been all that great. I mean, compared to what we're seeing now, did anything structurally change?
Yeah, no, I think there have been some changes. I think in the past, you would have a certain amount of, kind of stimulus coming right out of a recession when the government would try to, get things going after things had been very bad. But then it would kind of quickly they would reverse. And the theme for a long time has really just been worried about like the deficit and the debt, and that they didn't want to spend too much because that was going to make the deficit be too high and the federal debt be too high. And I think what happened, over the last maybe whatever 10 years or so, in some ways coming out of the 2008 crisis, there was a lot of, there was a big initial, fiscal support coming out of that, and it didn't raise the deficit and the debt for a while, but then it didn't last that long and kind of rolled back over again. And so after a couple of years, it kind of faded away, but it didn't do enough to bring kind of the underlying growth rate back up. So you had basically what you had a sort of a very sluggish, low employment kind of growth rate from 2010 to 2019. Basically, that whole decade was much weaker than it could have been because fiscal policy was relatively muted. People were worried about the deficits, and then COVID came along and kind of blew the deficit worries out of the water for a little while. People were just saying, we need to respond to this global pandemic, and so we had a huge deficit for a little while. And we saw that really worked. It kept people in jobs. It kept the economy afloat, and it did produce some inflation. But now that's starting to come back down again. But you're still getting kind of the benefits to the economy. And then you had this infrastructure-related stuff that has come along subsequently, and that's really the thing that's been different. That you had, even without a recession, you had significant fiscal support that was driven by roads and bridges, building factories, longer term not just giving people a check or unemployment insurance. It was long-term investments in the economy that came from the sort of a rare alignment of the politics. That the Democrats were in charge of Congress for a while and got these things passed, and those have had, I think, a bigger structural impact, or will have, than we've seen for a long time. Now, of course, Congress is split again, and we probably won't get any more of that for a while because of the politics. But I think that's been the difference just the last 2 or 3 years, and kind of has shown people that it can work, and that it maybe should be used more often, and helps counterbalance what the Fed is doing, because the Fed tends to sort of be worried about inflation, and then will not worry as much about growth. Meaning, if people lose their jobs, oh well, as long as inflation comes down, and that's kind of been a restraint on growth over the last 30 or 40 years.
And so, looking at those two forces and everything that else that's going on in the market, what if we were just talking about probabilities? So, there's a chance of a soft landing, or there's a chance of a recession happening. And a quick reminder to the listeners: a soft landing happens when there's cooling inflation while maintaining economic growth. So that's the optimal sort of scenario that a lot of people are hoping for. So, Sam, what kind of probabilities would you be attributing to the different scenarios?
Yeah, no, that's been a big topic. A lot of clients ask me about that, and in my mind, there's a there's a certain way in which we've already achieved what looks very much like a soft landing now, relative at least to what people were expecting, say, a year ago or even 6 months ago. Um, the official reported inflation data is not back to the 2 or 2.5% rate that the Fed considers the target rate, but we're getting close. And if you adjust some of the inflation data for the lags that are embedded in the housing component, which is a big component of the CPI and the PCE, the Fed watches, we're already basically at near or 2% inflation, and growth is still positive. Employment is still strong. So in my mind, we're almost already there, and certainly much closer to it than anybody would have expected. I think we will get there in the sense that I think inflation will continue to decline, and we'll see that kind of 2% ish inflation rate officially in the next few months. And I don't think we're going to see a recession in the next few months. So I think we will kind of get there in the next, say, 6 months or so. It'll be more clear in the data that we have had a soft landing. Now, people will always argue about that, or how long that will last. It may be that, by the time you get into late 24 or 2025, things start to look weaker. And then you say, well, then we're going to get a recession. And that could certainly happen. It's hard to look out, too far. But I think right now there's enough momentum and enough of that fiscal support that we can get, certainly over the next, say, 6 months or so, with positive growth and falling inflation down to sort of the target that the Fed wants to see. So I put pretty good odds on some form of soft landing happening. I think I don't see inflation going back up a lot. So I don't think the 70s kind of environment of, we're going to have a big resurgence in inflation is going to happen. I put very low odds on that. And a recession or worse than expected growth has, some odds, but that's probably maybe a 20-25% chance versus a much higher chance of kind of, slower but positive growth and lower inflation.
Hmm. It's great to hear. Positive news for all the bulls out there.
Yeah,
uh,
yeah.
so I have to follow that up and ask you: is there anything that would happen that would make you change your mind? Are there any specific things that you're following where, if a couple of headlines about X topic came out, you would say, okay, maybe that would tilt the scales a little bit more toward having a recession earlier on?
Yeah, no, you're right, and certainly, in my mind, policy mistakes, as you want to call it, that are the real risk in some sense. I don't see a lot of structural issues in the economy the way we might have had, say, in 2006 and seven, where debt levels were very high. There was all that kind of craziness in the mortgages. The banking system was weak. All those things that kind of set up that crisis that we then had. I don't really see that happening to the same degree now. There is still, I guess, some risk that the banks, some of the smaller regional banks, will have problems like they had back in March, if you recall, Silicon Valley Bank and some of those banks that got on the wrong side of the interest rate move. Essentially, their bond portfolios hurt them, and then depositors started to leave. But I think to some degree, the government has stabilized that, or at least removed the risk of depositors losing their money and it becoming a systemic problem. I think the banking system in aggregate is still doing okay. But I think the risk would be that either monetary policy gets too tight and stays too tight for too long, or that fiscal policy tightens too aggressively. We start talking about cutting the deficit again, and we start trying to restrict spending too much, and that would then cause that fiscal leg that's been holding us up to weaken or fall over, and then that would kind of bring the economy down, because it wouldn't have that kind of balance that it has right now. And then certainly, global events can do that. The Middle East is a concern certainly right now, and China has been a big driver of global growth for many years and is really struggling now. It's got a lot more headwinds than it has in the past. I don't think that's going to be a big crisis per se, as much as just simply a lack of the growth that it used to have. That it's just going to be much slower, and they won't be driving demand globally the way they did in the past. So I don't see a big imminent reason for that, unless either Congress or the Fed does something really, sort of unusual, and tightens policy too aggressively. I think it'd be the greater risk. And longer term, policy risk is really where a lot of the recessions end up coming from.
Those are great points. You mentioned, the big kind of debt load that the U.S. government is carrying right now. Um, is there? It just seems like such a complex issue that it's kind of easier to just kick the can down the road instead of really doing anything about that. Do you see that as a big long-term problem? When you look at the numbers, they're just staggering, very scary, big numbers.
Oh yeah, you're right, and I certainly see a lot of commentary and talk about kind of the size of the federal debt, or the deficit, and certainly the numbers are big, but I think in many cases the numbers are not put in context correctly. When you think about big numbers, you also have to think about the size of the U.S. economy, which is also extremely large. 25 trillion or something like that every year, and so in my mind, when you look at the U.S. federal level debt or deficit relative to GDP, or other measures of the overall economy, it's not really that extreme. It's higher than it used to be for sure, but it doesn't. It's not at the level that would cause a real kind of fiscal crisis or economic problem. In part because, of course, the U.S. federal government can issue as much money as it needs to. There's no actual limit on it. Congress obviously puts in arbitrary debt limits and things like that, and tries to shut the government down periodically. But those are politics. There's not an actual reason for that. Those are just dumb things that they do. Um, and so obviously, if the deficit stays too high for too long perpetually, it can be a problem. And the main problem for this a currency issuing government like the U.S. is inflation. That if you issue, if your deficits are too high for too long, you get inflation. Now that hasn't been a problem for a long time. For 30 or 40 years, inflation has actually been too low for many years. And so I don't really see that as an issue unless fiscal policy really becomes drastically different over the next 10 years or so than it has been, which I don't really see happening. Now, the state and local governments, kind of other areas of the economy, they don't have unlimited borrowing capacity or things like that. So there could be issues there, and certainly corporations and individuals can get into debt issues. But in aggregate, that doesn't seem to be a problem right now. Again, relative to say even 2006 or some area, times in the past. In aggregate, households are okay debt wise, and corporations are okay debt wise. So I don't see those areas being an issue. And the federal level, it isn't really a problem. And again, you look at Japan as an example. Their outstanding federal government debt is much higher than ours is relative to their GDP, and has been for years. And they haven't had any problems with it. They're basically the Bank of Japan just buys whatever they need to, and rates are low, and they don't have any inflation much, and their economy's not great, but it's okay. And so all those problems that people are worried about haven't happened. So if you're a currency issuing government, you have a lot more flexibility. Whereas areas like the euro or other countries where they don't have the same fiscal flexibility, it's a different story.
Mm-hmm. And I wanted to ask your take on some specific asset classes. And so the first one I wanted to ask you about was the U.S. real estate market. So both from a commercial and residential perspective, what are your thoughts on what's happening there with interest rates, of course, being a big factor affecting the asset class, affecting cap rates? What are your thoughts currently, and do you favor this asset class long term?
Yeah, it's been a really interesting area to look at. There's been a lot of, to me, what look like divergences in terms of what you'd expect or what one part of the market is doing versus another part. I think residential housing is okay in the sense that it's holding up better than a lot of people expected. And there, what you've really seen is the divergence is incomes have been rising. So from an income level, people can afford to buy a house about as much as they could, say, 2 years ago. What's changed, of course, is the financing cost. And so, if you want to, buy a house out of your income, that's one thing. If you need to finance and get a mortgage, you're paying 7 or 8% now versus 3 or 4%, 2 or 3 years ago, and that's really where the what's made houses more expensive. It's not the house price itself as much as it has been the financing cost. And so there it depends on who you are and what you are and what's going on. But it's also meant that whoever does have a low rate mortgage from the past doesn't want to sell. So there's basically no inventory. There's very few houses for sale in the U.S. In terms of existing homes being offered for sale. So there is still demand for housing. So the prices of houses have not fallen like you might expect them to when mortgage rates have risen. And of course, people who are looking to buy a house are having to think hard about whether they want to take on a 7 or 8% mortgage rate to buy a house. Now, so that'll probably take a while to kind of work its way out. So the market's sort of locked in some ways. The buyers don't want to buy, the sellers don't want to sell, so there's just not much happening. I think that'll kind of loosen it at some point, but it'll take a while. In commercial real estate, you have kind of the effect of COVID, where people are office buildings, people aren't going back to the office as much as they used to, and you have higher interest rates, which makes it harder to to finance the cost of commercial real estate, and that's been a double whammy for a lot of these kind of commercial real estate areas. So they've just been really knocked down hard. They've been negative in the work that I do. All the like real estate investment trusts and kind of related companies have just been really slammed, both in terms of the stock prices and their earnings estimates that I track closely. There have been actually some signs of maybe the worst is past, at least in terms of what people's sentiment is. Again, the same way people thought about the economy last year, people think about real estate. It's never going to end. It's just going to be bad forever. There's a lot of negativity there. So if things are even a little less bad than people expect, maybe there's an opportunity in certain areas. So there have been some of the REITs in areas that have actually been popping up as being attractive, at least for the next maybe few months or 6 months or a year, as kind of a contrarian play. But you have to be selective. It's not the whole area. Only areas where there's demand in certain things, and they've worked out the costs of financing, things like that, where there might be some opportunities. I think just because everyone's gotten so negative on the whole space, but I don't think it's going to bring the economy down. But I think it's going to be a drag on banks that lend money to them and to the companies themselves for a little while longer.
With the limited inventory that you mentioned on the residential side of things, I kind of think of, let's say, like a small cap stock where there's low liquidity can lead to big price swings. Could that be a contributing factor in a correction in the residential real estate market?
Yeah, no, you're right. And to the extent that the amount of activity, just the level of transactions in the market is relatively low, then it doesn't take as many transactions to kind of move prices or kind of to change people's views. And I do think that is because people are kind of stuck in some ways now. That the buyers want to get the high price and the sellers want to get a lower price, and they can't find a way to meet in the middle as like they normally would. When one side kind of breaks, then things can move quickly sometimes. Now there are a lot of geographic differences across the country as well in terms of demand and supply, and the fact that a lot of people are now, because they can't find an existing home to buy, they go and buy a newly built home. So the home builders have actually been very busy in selling a lot of houses because there's not enough existing home inventory. And so in places where they are building new homes, there's still demand for them. That's been a big surprise that a lot of the home building companies have not fallen like you would expect when mortgage rates go up, because they're still busy building homes. But again, that won't last forever. So I think and there's been a lot of like multifamily apartment being built. So as those come online, you might see rental prices and prices for real estate in general coming off some. So I think it's gonna be a slower moving thing. I think, but I think you're right that at some point it may be that um, the sellers decide they will take a slightly lower price, and then things go from there a little bit to push prices down, or at least keep them from going up any further.
Yeah, I mean, there's a lot of factors that could come into play there. So you mentioned some parts of the real estate market could be somewhat attractive as a contrarian sort of play. And if you were an investor right now looking for fertile hunting grounds for some investment ideas, what regions or asset classes or sectors do you think would offer the best sorts of opportunities today?
Yeah, so I think right now I still prefer, say, equities over bonds. But there'll probably be a point at some point, maybe 6 months from now, but not too distant future, when I think bonds will be more attractive, particularly for people who are looking for income and kind of safer assets, retirees, things like that. Bonds have not been a safe place to be for several years now, and so I think you might have a bumpy ride for a little while longer, but at some point it'll become attractive. So I would still probably stay with equities certainly for now. I think there are, like I say, some opportunities in commercial real estate and REITs and things, but you have to be a bit careful. And I think globally, I think the U.S. still probably is the place to be in terms of the dynamism of the economy, the tendency for shareholders to be rewarded in the U.S. relative to say Europe or China or a lot of other markets globally. There's just much more of a shareholder focus here, and has been for a long time. And the technology related areas, which are very much dominated by the U.S., I think are where the long run growth is really still going to come from. So I think that the question there is really just whether you pay too much for it. It's a valuation question. I think the growth is still going to come from technology and technology adjacent areas. It's just a question of you don't want to buy after a big move up when things are very expensive and everybody's excited about them. You got to wait for pullbacks and declines to buy, which can be tough to do psychologically. Nobody wants to buy stuff that's going down, and so I think that's the difficulty is finding good stocks to buy that have the growth potential, but just not paying too much for them. So I think technology related areas, the U.S. is probably still the place to be, and equities for the long run I think are still the place to be. But bonds will be less of a bad place to be than they have been for much of the last five or 10 years.
And that makes a lot of sense thinking about where interest rates are now. I mean, cuts are on the horizon at some point, I would imagine. So that would be definitely very positive for any bondholders. And I wanted to ask you something about the fixed income side of things as well. So it seems like spreads have been relatively narrow despite all of this kind of economic uncertainty in the background. I know you mentioned that we're might be right in a soft landing scenario right now, but there still seems to be a lot of uncertainty in pockets in the economy. And so, why do you think spreads are so narrow? Is this just a factor of investors saying yes, we're in a soft landing situation, or is there anything else that might be causing this?
You're right. I mean, I think to some degree, I think the bond investors that are looking at the corporate bonds are seeing a relatively stable U.S. economy, and again, corporate profits have actually been pretty held up pretty well and are going up. Meaning that the earnings estimates that I track have been rising for most of this year. In fact, they bottomed around January or so, and are still going up. And so that tells you that corporate profits, which is what is tied closely to the corporate debt, the ability of companies to pay their debt, which drives spreads, are still pretty solid and have been improving. And again, corporate balance sheets, certainly for the larger companies, are in decent shape. So there's some fundamental reasons for that. And also, spreads are narrower than they were, but actually in like 2021, when everybody was buying everything, the spreads were actually a lot narrower then. So they're not as narrow as they could be, or as they have been even a couple of years ago when they were really sort of extreme, I would say. I think they're closer to sort of normal historical average levels in non-recessionary periods right now. So I wouldn't call them extreme tight, but they're sort of typical for economic data like we've seen, which is sort of moderate growth and declining inflation, but again reasonably good corporate profits and balance sheets, which I think is the key. And so far, there haven't been any real big reasons to expect that to change imminently to drive credit spreads up. So to me, it kind of makes sense if you, as long as you don't think that there's a recession right around the corner, for spreads to be where they are, and
Mhm.
I don't.
Mhm. That makes total sense. Now, earlier on, we talked a little bit about how the market is not the same as the economy, how the market is more forward looking. The economy, usually, you're just looking at data that has already happened in the past. What would you say are some factors that can lead to more of this sort of decoupling from where you can see markets keep going up? And if you were looking at the headlines, the economy does not seem like it's in good shape.
Right, right. And I think there's a couple of things. One is that the headlines are often not a good way to judge. The people who write business headlines, they do a good job of doing what they do, but they're journalists. They're trying to get interest, get you to read their paper or get clicks. They're not economists. They're not going to describe things in context always, or necessarily give you the right kind of frame of reference. So I think that's one risk, but also that there's a lot of sentiment that goes into equity prices in particular, and kind of what people expect for the future can be pushed around by a lot of different things. So one day it's the Fed driving things, one day it's maybe fiscal policy, one day it's oil prices, one day it's China, one day it's some big company announces something, Apple or Tesla or Amazon or some big dominant company does something. So there's a lot of different things that will grab investors' attention at different times and cause them to push prices up or down, even though the GDP or some other economic data might be saying something else. Yes, it says that, but that's not what people are looking at that day or that week. And so it's a matter of kind of almost market ADD. Their attention moves around from one thing to another, and there's a lot of different things that each on their own are reasonable things to look at. Interest rates are important. Corporate earnings are important. Oil prices are potentially important, and all these things are important. But it's hard to track them all at the same time. And then whatever one happens to be in the headlines or gets attention that day is what drives prices around. And then people just they get excited, they get bullish, they get or there's just more money around to invest, and they got to put it somewhere, and so they stick it somewhere, and so they're less sensitive to what the data might be saying. But overall, I think corporate earnings and interest rates are the two big drivers, and in some ways they've been almost offsetting each other a lot certainly in the last few months. Earnings have been pretty good, but interest rates have been going up, so you got a headwind and a tailwind, and so stock prices have been kind of choppy and back and forth for a little while. Back around say March, kind of, or maybe May, June, July, rates looked like they were stable. Maybe they're going to come down, and earnings were pretty good. So you had the market going up, and much more sort of one directionally, and so that kind of tells you, when the story kind of went away, earnings became the topic, and that pushed them up. Now the rates are back to being the story, and earnings less so, and now let's push prices down. So that's kind of how I look at it: is which of those things is the thing that the topic du jour, and right now it's interest rates. But after, if interest rates stabilize, it'll go back to being earnings or oil or something else.
It reminds me of the analogy that Warren Buffett used, where he's talking about Mr. Market, which is kind of, like an obsessive compulsive sort of neurotic entity. And, one day they're happy and one day they're very extremely pessimistic, and it can swing very wildly from day to day.
Absolutely.
And so emotion can really drive a lot of that instead of just pure logical decision making.
Right, right, exactly. And being able to take advantage of that and kind of keep your head while everyone else is losing theirs, kind of thing. That's how you can get ahead, or at least avoid mistakes. And that's really part of what having objective models and indicators, or some kind of a plan, that where you don't read the headlines and then decide what to do. You decide what you're going to do, and then respond to the data.
That's great, Sam. So I just want to say thank you so much for joining us. I want to give a plug for your Twitter or X account. You post some great insights on there. So I really recommend all of our listeners to go and follow you there.
Sure, sure. Yeah. So yeah, the Twitter handle is at Mill Street Research. So you can find there. I'm posting most every day comments about what I'm seeing. I'm also Mill Street Research is post on LinkedIn. So if you're on LinkedIn, I post there periodically as well. And then there's a website millstreetresearch.com where you can see examples of the research that I produce. There's a blog there that I update once in a while, and a lot more background and description of kind of what I do and how I do it. So any of those places are good places to look, but certainly the Twitter at Mill Street Research there is probably where I post most frequently.
I'm still getting used to saying X. It's just
I can't
it's a
do
hard
it.
one. It's a hard one.
Yeah, I'm going to say Twitter till it goes away. Yeah.
Well, Sam, once again, thank you so much for joining us. I really enjoyed this conversation, and I'm sure our listeners are going to get a ton of value from your commentary. Thank you again for joining us, and I hope you have a great afternoon.
Oh, thank you for having me on. It's been my pleasure.